Credit markets are flashing red. The signals are undeniable. A stock market collapse could be imminent. I'm your host, Steve Van Metre, and thanks for joining me today. In our show today, credit markets don't lie, and their latest signals are terrifying. And credit markets aren't the only ones that don't lie, as today's labor market data is also pointing to a major market collapse. Just wait until you see these charts. Plus, we have a sponsor for today's show. I'd like to welcome Sky Query back. You can find them on the NASDAQ under symbol SKYQ, and they're strategically positioned to capitalize on the imminent supply shortages in California's fuel market due to legislative changes and refinery closures, which is setting the stage for growth in 2025. They just began promising swing trade with the stock closing above its rising 9-day simple moving average, which we project a potential upside return of 58%. Just wait until you see these charts. Now, we've been warning that the internals of this market were starting to fall apart in a big way as everyone was crammed in at the top. Now we're seeing some big players sell, and credit markets are flashing red. And we've seen this happen twice before. Once before the dot-com bubble, the second time before the global financial crisis. Now let's head over to Bloomberg, where I picked today's story up with the headline, is credit markets signal warning for a relentless equity rally. And right now, investors believe the stocks can only go up, and they're willing to pay any price to buy them. The problem is that credit markets are now telling them it's time to sell. And stocks are close to the most overvalued against corporate credit and treasuries in about 2 decades. The earnings yield on the S&P 500 shares, the inverse of the price-earnings ratio, is at its lowest level compared with treasury yields since 2002, signaling that equities are at their most expensive relative to fixed income in decades. And yet everyone believes that stocks can only go up as the economy is going to boom and earnings are going to surge. And what we're seeing with investors is they want to front run this, but in reality, they're buying stocks at a massive premium. And what credit markets are again warning, it's time to get out now. The equity profit yield is usually above the BBB figure because stocks are riskier. And since the turn of the century, when the gap between the two figures has been negative, as it is now, it tends to spell trouble for the stock market. Over that period, such a negative read has only ever occurred when the economy was experiencing a bubble or soaring credit risk, and arguably with stocks trading at their current valuations, there's no doubt we're in a bubble. The problem is, just like past bubbles, people don't believe it. But yet the charts don't lie. As we take a look at this first one, as credit markets suggest that stocks are massively overpriced, and we can see that when the earnings yield is low relative to the BBB bond yield, well, what happens? You go into the dot-com bubble. Here you see around 2000. Then you have a financial crisis going into 2008 and 9. And how about now? Well, we're facing another massive bubble, one so big, we'll call this one the AI bubble. But if you're looking for an opportunity to make money, check out this next chart of our sponsor of today's show, Sky Query. You can find them on the NASDAQ under symbol SKYQ. And just yesterday, they closed above a rising 9-day moving average. That is the initial point of a swing trade. Now, how high can this go? Well, we think there's a potential this stock could jump by 58%. Stay tuned to the end of the show or check out the pinned comment or description for more information. Because when you look at BBB yield and any of the other benchmark ones, the 10-year, the 2-year, there's a very significant gap between them and equity profit yields. And historically, that's often preceded a pretty significant drawdown. One so significant, we could argue, it's preceded the last 2 recessions. And that is a dangerous point for right now, because what we have is investors and speculators and money managers and hedge funds massively overweight U.S. equities, betting everything on a rising market. The risk here now is squarely to the downside. And let's turn to Goldman derivatives guru John Marshall, who noted that funding spreads are a proxy for professional investor positioning, and who wrote that, quote, funding spreads resumed their climb over the past week following a mid-November volatility, and this suggests there's been no reduction in appetite for equity upside from professional investors in the futures, swaps, or options market, and this is a bullish sign for future near-term equity performance. And sure enough, we did see the markets go higher, but now the risk is that everybody's all in, and when everybody's in, the markets tend to go the opposite direction. And here you can see the relationship between average funding spread in red and the S&P 500 in blue, showing that where funding spreads go, the market tends to follow. And Marshall's theory that institutions were piling into stocks with leverage and at an unprecedented pace pushing the S&P to new daily records. Well, that was spot on, and that's something we've been warning about. The leverage in this market was sky high, that people weren't just betting, they were gambling on the future of stocks. And that happened up until December 18th, the day of the hawkish FOMC, and when we all know, quote, political Powell decided to make a dramatic U-turn on the Fed's dovish pivot less than 3 months earlier, and is now warning that the Fed will cut far less than previously expected, potentially, if at all. And with that, the party was over and funding spreads cracked. And sure enough, we can see that in a big way on this chart as we see funding spreads plummeted. And this is preceding what is likely a major downturn in the market. Could be the beginning of the next financial crisis or just a burst of the AI bubble. Love to know what you think. Do you think this is just a minor blip in the road and a longer trend up of stocks? Or do you think we're on the cusp of a massive recession? Weigh in the comments below. Love to get your opinion. And while you're there, check out the stock for our sponsor of today's show, Sky Query. Find them on the NASDAQ and symbol SKYQ. But if funding spreads surging was a bullish sign, as Marshall noted back in December, wouldn't plunging spreads be bearish? Well, the chart of continued signs of degrossing across institutions is a significant warning sign for equity investors. Marshall goes on to say that selling through the futures channel continued this week as evidenced by the decline in the cost of funding levered longs, and cautions that weakness in funding spreads on Thursday was a significant occurrence because it demonstrated the December move down in stocks was not just year-end related and had everything to do with credit spreads, and what we're facing here is a potential massive drop in equity prices. The punchline is that while equity valuations have been historically high for many months, this is the first time we're seeing significant selling in both of these positioning measures in years. And with potential correction brewing at some point, which is inevitable, we've noted on our Sunday show that we continue to see stocks following a rising trend line. At some point, they're going to break this and come falling down in a major way. What we see is investors are content to take risk for now. And whether it's pouring into equities at sky-high prices or putting money into crypto, equities are trading about 27 times their earnings for the last 12 months, compared with an average about 18.7 times for the last 2 decades. So what we're seeing here, once again, is investors not just buying at the high, they're buying, betting on the market, doing something it hasn't done, and that is break the long-term average of earnings. This is highly unlikely, indicating that any cracks in corporate earnings could send stocks plunging. What we're seeing here in the triple B market credit spreads is that it's exactly happening right now. And generally, higher bond yields signal that equities need to generate greater returns to keep up, which could imply that current stock prices should be lower. But one of the big questions in financial markets right now is how long will that take to happen? Bonds are less expensive than risky asset stocks, and as treasuries remains under pressure pushing yields higher, equity valuations should adjust lower to remain competitive, indicating that we could be on a cusp with everyone all in this market where we see stocks plummet. This is at a time when liquidity is low, corporate share buyback blackout is in effect, not to mention we know that machine positioning and systematic quant products are very long this market, meaning any move down could cause a huge wave of selling. But it's not just the credit markets that are flashing red. As we turn to the labor markets, we see a similar sign that points to stocks going down. As U.S. job openings rise to 6-month high on business services, so what we see is businesses are entirely betting big on a rebound in the economy. The advance was led almost entirely by openings at professional and business services, which stand at an almost 2-year high, as well as finance and insurance. But here's the problem as we look at this. We talk about the manufacturing sector, not just here in the U.S., but all around the world. And what do we see? It's continuing to slow down. There is more capacity than there is actually demand. And so what we're seeing in the manufacturing sector is the exact opposite, as a combination of food services and manufacturing reduce posting, which means that as all these services businesses ramp up on increased potential business for manufacturing. Now keep in mind, manufacturing drives 70% of all services. Well, what we're going to find out is these services jobs are going to disappear very quickly. And when we look at the job openings and labor turnover survey chart and overlay this against the NASDAQ 100, well, it suggests that something is going to change in a big way. Either job openings need to surge higher, or the NASDAQ needs to come down from its lofty high, and based on what we're seeing on the credit markets, that could happen sooner than later. And now the job market appears to be on better footing, and inflation has proved stubborn in recent months, scaling back expectations for how much policymakers will lower rates this year. And this is important because this is exactly the issue that's happening in credit markets right now. The notion that the Fed was going to have a whole lot of cuts next year is now dropping off the table in a big way as inflation expectations are at their highest since February 2023. The market no longer pricing in a full cut by July, suggesting that what we're seeing in credit markets could have a disastrous effect on equity markets, sending stocks plunging. Now let's turn to the U.S. Services Index, which climbed higher, but on one big problem, the price gauge now hit its highest level since 2023. The Institute for Supply Management's index of services advanced 2 points to 54.1 last month. Readings above 50 denote an expansion, which is what we've been seeing around the world as the services sector is keeping the global economy from dropping into recession. But for how much longer, we're not sure, because we know that the services sector follows where manufacturing goes. This has everything to do with the fact that manufacturing drives about 70% of the services sector. The measure of prices paid for materials and services, which is a huge problem now, rose more than 6 points to 64.4. So at a time when we're already seeing budgets stretched at the household level and we're seeing a slowdown in the manufacturing sector, prices went up. And this means services companies are going to be forced to pass these on to the customer. And as it already stands, we're seeing that demand is weakening, meaning the dollar for customers and businesses isn't going to go as far against these higher prices. That's going to lead to further decline in demand and more people on the unemployment line. However, big single month moves often unwind without ever showing up in the inflation numbers, and so that could be just a one-off print. Well, we'll find out soon enough. But let's take a look at the services PMI, because while new orders rose to 54.2, which is a great sign, we see the trend up now for 6 months. What you can see in the employment data, which has been rising at a slower pace, turned in at 51.4, shows that services employers are not confident that this is going to last. They think this is transitory. Otherwise, they'd be hiring and hiring in a big way. And we go back and look at the continued unemployment claim data and the initial claims data, we see no evidence that the services sector is really turning around here. And part of that has to do with backlogs of orders that printed in at 44.3, now seeing 5 months of contraction and an accelerating rate, meaning there aren't enough new orders for all the workers to keep them busy. They're chewing through the backlogs. That's why we're seeing employers nervous about the labor market. But the headline print of the ISM and the JOLTS survey has got the Fed on the potential sideline here, putting credit markets in the red, suggesting that equity prices could head lower. But there is one company we are bullish on, and that is a stock for our sponsor for today's show, SkyQuery. You can find them on the NASDAQ under symbol SKYQ. Everything you need to know in the pinned comment and description below. We've got some great updates on where this company is headed. Not to mention, we'll take a look at that swing trade setup, what we think could catapult SkyQuery stock up as much as 58%. And SkyQuery is an integrated energy solutions company committed to revolutionizing the waste asphalt shingle recycling industry. They've got a focus on sustainability. They've got a huge market opportunity, and their growth is accelerating. And currently, there are no sustainably viable solutions for the disposal of waste asphalt shingles. They have an estimated 700 million tons of asphalt shingles have been dumped into landfill since the 60s, and 80% of North American homes have asphalt shingle roofing, with the average house generating 2 to 3 tons of tear-off waste per year. And this is a massive opportunity for SkyQuery, because their innovation lies in their patented EcoSolve technology, which has a material recovery rate of up to 95% and recycles up to 99% of its solvent and recovers up to 99% of higher carbons. How do they do that? They grind up waste asphalt, they mix the material with their solvent, then they move to the extraction process and distill it. What you have here is a process that is energy efficient, it's closed loop, it's cleaner, and it's eco-friendly. And they have a sustainable business model, as they're one of the most compelling aspects is they get paid what's called a tipping fee to take waste asphalt shingles. And these tipping fees range from $45 to $150 a ton. And most of these costs, if not all, cover the process to break down the shingles. And since the cost to separate and recover shingle components are covered by the tipping fees, nearly all the revenue from the recovery process contributes directly to the profit line. And national and state regulatory regulatory landscapes are also empowering Sky Quarry's bottom line and their future. As EPA and regional governments move toward banning shingle landfill disposal, Sky Quarry is poised to become one of the few viable options for shingle waste disposal. And they have revenue. They have revenue growth, their assets strong, and they have rapid scalability as they're in the process of establishing smaller self-contained facilities nationwide that will receive and process asphalt shingle waste in areas with the largest concentration of the material and have the highest tipping fees. Let's take a look at some of the recent announcements as they just picked up coverage from Zacks Small Cap in a research report, and they partnered with Zacks Small Cap Research to release a new research report titled Developing a New Approach to Recycling Waste Asphalt Shingles. This partnership with Zacks marks a key step in expanding awareness of Sky Quarry's business and advancing its mission to transform the waste to energy industry. And they issued a recent shareholder letter and corporate update. And 2024 has been a transformative year for Sky Quarry with significant achievements in shaping the future of their company. And since their founding in 2019, the mission to transform waste asphalt shingles into valuable, sustainable resources has been the driving force behind everything they do. And recent proposed legislative changes affecting California's oil refineries, including the planned closure of Phillips 66 140,000 barrel per day Los Angeles refinery, is expected to drive a significant shift in regional fuel supply, indicating a tight market and potential shortages of products. Since California provides over 150,000 barrels a day to fuel to Nevada, Sky Quarry sees significant market opportunity and believes that by capitalizing on it, we can solidify our position as a key player in the Western fuel market. As a sole crude oil refinery operating in Nevada, our strategically located facility is poised to provide the market additional refining capacity. Free from the stringent restrictions faced by California-based refineries, our production is expected to increase in 2025, and amid the anticipated reductions in supply within the Nevada market, we believe we are well positioned to capture market share and achieve higher refining margins driven by regional scarcity. Let's take a look at their chart, because as we see credit issues in the broad market, there's going to be opportunities, and we think Sky Quarry is one of them. You can find it on the NASDAQ under the symbol SKYQ, and just yesterday they entered a swing trade. Now, you find a swing trade is when the 9-day simple moving average is above the 21-day exponential moving average, and you get a candlestick close above that. That happened yesterday, and this is setting up a big potential move, one that we think could catapult the stock higher by 58%. And when we go back and look at the charts, you can see right around $1.97 is the last place we saw sellers arrive, setting up a potential move here. And you can see volume support underneath this, along with rising momentum validated by the relative strength index and the MACD, which could potentially send Sky Quarry's stock up by 58%. Be sure to check out Sky Quarry on the NASDAQ under the symbol SKYQ. And as always with any company we feature on our show, you're under no obligation to purchase their stock. Be sure to do your own research before placing any trades. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.